3 nights at Bellagio in 2026 will cost $187 in mandatory resort fees before you touch a slot machine, sit at a table, or order a drink. That's not a mistake on your bill. It's one line item inside a 10-step extraction model that most visitors never see in full. Here are all 10. Number 10. The resort fee ceiling. By January 2026, Aria and Bellagio are both charging $55 per night in resort fees. With tax, that comes to $62.36. Caesars Palace is charging $54.95, which comes to $62.31 after tax. These are not optional upgrades. They are not tied to a specific service you requested. They show up on your bill the same way a government tax does, but they are not a government tax. They are a mandatory cover charge for a building you already paid to sleep in. The number itself matters less than the trajectory. A few years ago, most of these properties were charging below $30. The fee did not grow because the amenities improved. It grew because the operators realized guests would absorb it. Wi-Fi that costs the hotel almost nothing to provide, gym access most guests never use, a newspaper nobody asked for. These are the listed justifications. What the fee actually covers is the gap between what the property wants to earn and what the room rate alone can generate. At 3 nights, that is $187 gone before you have placed a single bet or eaten a single meal. That is the number your confirmation email did not lead with. Number 9. The parking extraction. Self-parking at major strip resorts now runs $18 to $25 per night. Valet runs $25 to $45, with rates climbing higher on event nights, and those event surcharges are applied without advance notice, meaning the price you saw when you booked is not the price you pay when you pull up. This is paid parking. 10 years ago, parking on the Strip was free. Not discounted, not bundled, not hidden inside a resort fee. MGM Resorts began rolling out paid self-parking in 2016. Caesars followed. What started as a policy exception is now industry standard, and the pricing has been steadily ratcheted up every year since. The logic is the same as the resort fee. Guests are already committed to the property by the time they arrive, so the cost of refusal is high. That's not hospitality. That's a captive market being priced accordingly. If you drove to Las Vegas and stayed 3 nights at a flagship MGM or Caesars property in early 2026, you could easily spend $75 or more just to park the car you drove there. That cost did not exist a decade ago. If you've paid one of these fees recently, drop the amount in the comments. The numbers people are actually seeing at checkout are worth documenting. Number 8. The CNF surcharge. This one does not show up on your hotel bill. It shows up on your dinner check, usually in small print near the bottom, listed as a CNF fee or a concession and franchise fee. The rate runs between 4.7% and 4.85%, and it has been documented at multiple Strip restaurant locations, including spots along the Link Promenade and Paris, Las Vegas. It is not a government charge. It is not a sales tax. It is an invented line item that operators themselves describe as a surcharge to offset the rising costs of operating inside a resort corridor. In plain language, the casino charges the restaurant a high rent to exist on the property, and the restaurant passes that cost directly to you, disguised as something that resembles a tax. State and local sales tax gets applied on top of it. So you are paying a tax on a fee that was never a tax to begin with. The CNF surcharge is the most invisible item in the extraction model because it hides inside a category most diners assume they cannot challenge. You see it, you assume it is official, you pay it. Some guests have had it removed by simply asking. Most do not ask because nothing about the label suggests that is an option. The fees covered in this section, the resort fee, the parking charge, the CNF surcharge, are all visible if you read the bill closely. What comes next operates at a different level entirely. It happens before you ever check in, inside corporate balance sheets and earnings calls that most guests never see and most journalists never explain. That's where the real structural damage starts. Number 7. The REIT sell-off. Most people assume the company whose name is on the building owns the building. On the Las Vegas Strip in 2026, that assumption is wrong for some of the most famous addresses in the world. MGM Resorts sold the physical real estate beneath Bellagio, MGM Grand, and Mandalay Bay to REIT partners, real estate investment trusts whose entire business model is collecting rent. MGM still operates those properties. They still put their name on the door, but the land and the structure belong to investors whose only interest is the lease payment arriving on schedule. MGM's investor materials describe this as an asset-light strategy, a way to free up capital and optimize the balance sheet. What it actually creates is a structural ceiling on reinvestment. Every dollar that goes toward upgrading the property is a dollar being spent on someone else's asset. The REIT gets paid regardless of whether the carpets are new or 10 years old. The incentive to reinvest has been architected out of the ownership structure. This is not a temporary arrangement. It is the direction the entire industry is moving. Caesars has run similar playbooks on parts of its portfolio. Operators are becoming brand managers and loyalty platform operators, not hoteliers. They manage the customer relationship. Someone else owns the dirt. Number 6. The non-core label. Pay attention when a casino corporation uses the phrase non-core asset in an earnings call, because that phrase is doing specific work, and non-core is not casual language. It does not mean the property is struggling. It means the land beneath it has become worth more than the business sitting on top of it, and the company is signaling that a sale is within range of consideration. Land is the driver. Caesars has explored selling the Flamingo for somewhere between $2 billion and $2.5 billion. That valuation is not driven by what the Flamingo earns as a casino. The Flamingo's operating performance on its own does not justify a $2 billion price tag. What justifies it is the location, Center Strip, one of the most valuable corridors of commercial real estate in the United States. The land is what the buyer would be paying for. The casino operation is incidental. The Flamingo opened in 1946. It has survived ownership changes, renovations, and decades of competition. None of that history protects it from the math. When a corporation looks at a property and concludes that the land is the valuable part, the building's future becomes contingent on whether a buyer materializes at the right number. Non-core is the quiet admission that the conversation has already started. Number 5. The minimum viable product strategy. Circus generates roughly $90 million in EBITDA annually. That is not a struggling property by cash flow standards. The leaking ceilings, the faded paint, the chipped fixtures that fill every visitor review, those are not the result of financial failure. They are the result of a deliberate operating decision. Keep costs compressed, hold the price point low enough to sustain occupancy, Extract the cash flow. Put nothing meaningful back in. Costs are controlled on purpose. Phil Ruffin bought the property in 2019. He has been trying to sell it since at least 2025. Brokers pitching the parcel to prospective buyers have placed the land value alone at over $500 million. 67 acres sitting on the North Strip, generating $90 million a year in cash while the owner waits for someone to pay for the dirt. The $2 beers and budget room rates are not hospitality decisions. They are occupancy tools designed to keep the asset producing income while the sale process runs its course. Occupancy is the aim. The minimum viable product strategy is the most honest version of what is happening across the mid-tier strip. You provide just enough: a bed, a working shower, a casino floor with the lights on, to justify the rate and keep the rooms full. The guest experience is not the point. The guest is the mechanism that keeps cash flowing until the land deal closes. Minimum is the business model. That is the asset stripping layer. Sell the real estate and lease it back. Label the aging properties non-core and run the remainder on the thinnest possible operating margin. From a corporate spreadsheet, it is rational. From the inside of an elevator at a property that last saw real capital investment in 2012, it feels like something else entirely. The next 3 items on this list are what that strategy looks like on the ground when you are the one staying in the room. Number 4. The capital triage logic. When a portfolio is under financial pressure, capital does not get distributed evenly. It gets directed toward the properties with the highest return potential, and it is quietly withheld from the ones that do not make that cut. Inside MGM's strip portfolio, that logic has a visible outcome. Aria gets the investment. Bellagio gets the renovation budget. Excalibur and Luxor get the deferred maintenance schedule and a reduced headcount. Since spring of 2025, MGM eliminated up to 1,100 part-time roles across its strip properties. Excalibur absorbed the deepest cuts to frontline services. Housekeeping frequency dropped. Food and beverage outlets were consolidated. These changes do not make headlines. They show up in guest reviews: a room that was not cleaned on day 2, a restaurant that closed an hour earlier than the sign on the door said it would. The degradation is real, but it is designed to be gradual enough that no single incident forces accountability. The triage logic is not unique to MGM. Any operator managing a portfolio under revenue pressure faces the same calculation. The difference is that on the Strip, properties at the bottom of the priority list are still charging resort fees at the top of the market. Excalibur guests paid $45 per night in resort fees in early 2026, $51 with tax, for a property receiving less capital investment than at any point in the last decade. The fee did not decrease when the reinvestment did. It never does. Number 3. The debt ceiling on reinvestment. Caesars Entertainment carries roughly $11.9 billion in total debt. Before a single card is dealt on any given day, the interest payments on that debt are already consuming capital. That's not dramatic framing. It's arithmetic. A company servicing that level of debt at prevailing rates is paying out hundreds of millions of dollars annually, before operating costs, before payroll, before anything touches the physical condition of the buildings. Walk through Harrah's in 2025 or 2026, and the evidence is right in front of you. Stained hallway carpets that appear to have absorbed years of foot traffic without replacement. Elevators that announce their age with every slow, groaning descent. The smell in the lobby that no cleaning schedule seems to fully address. Travelers online have been calling it the Walmart of the Strip for years now. That description isn't an exaggeration. It's a fairly accurate summary of what happens when a property's only job is to generate cash flow, while the parent company services a debt load most mid-sized countries couldn't carry. The carpets and elevators at Harrah's aren't accidents. They're the physical expression of a balance sheet. When the debt ceiling is that high, reinvestment in aging infrastructure isn't a priority. It's a luxury the numbers don't permit. Number 2. The ghost infrastructure problem. At Circus, a power outage in the North Tower forced Clark County fire crews onto the property to rescue guests trapped between floors. The outage hit on a Friday night. Power and elevator service were not fully restored until over an hour later. Downtown at Neonopolis, elevators and escalators sat out of service for months into early 2026, raising documented Americans with Disabilities Act accessibility concerns and leaving disabled visitors effectively stranded from entire vertical sections of the complex. These two incidents do not involve the same company, the same building, or the same type of failure. What they share is the underlying condition that produced them: vertical infrastructure. Treated as a discretionary maintenance cost rather than a baseline operational requirement. When budgets are compressed and capital is flowing upward to service debt or toward flagship properties, the systems that quietly keep buildings functional are the first to get deferred. They do not fail dramatically on day one of deferred maintenance. They fail gradually, and then suddenly, usually on a Friday night when the building is full. The ghost infrastructure problem is what the minimum viable product strategy eventually becomes at scale. Run the asset hard, put nothing back in, and wait. Somewhere in that waiting period, an elevator stops moving. The question is only when. Number 1. The land value inversion. On March 15, 2026, Bally's Corporation confirmed the permanent closure of the Tropicana Las Vegas after 67 years of continuous operation. The stated reason was unsustainable operating losses exceeding $50 million annually. Within hours of the announcement, 1,200 employees lost their jobs. Gaming stopped. The hotel stopped. Everything stopped simultaneously on a property that once held the largest casino floor on the entire Strip. The land is being cleared for a Major League Baseball stadium. Strip gaming revenue in 2025 rose by 0.03%. Visitor counts fell to a 4-year low. The early 2026 recovery is being driven by higher room rates extracted from fewer guests, not by any growth in actual demand. The asset value is moving away from the buildings and toward the ground they sit on, and that migration is happening faster than the corporations are willing to say out loud on earnings calls. The Tropicana didn't close because of one bad quarter. It closed because the math of demolition finally beat the math of operation. That's the logic this entire list has been building toward, and it's now moving down the Strip one address at a time. Every fee, every deferred repair, every non-core label on this list is the same equation running at a different speed. The resort fee is the fast version. The closed casino is the final one. Subscribe so you don't miss the next property that crosses that line. The list is not finished.